XRP crossed $1.2 billion in ETF assets, Bitcoin hit new highs, Tesla stock multiplied, real estate prices soared, and millions of people convinced themselves they were building wealth. They checked portfolios obsessively, celebrated green days, panicked on red days, felt rich when numbers went up, felt poor when numbers went down. But here's the question nobody asks. If you're checking the price every day, are you building wealth or are you just speculating? Because there's a difference, a profound, life-altering difference that separates people who get rich from people who just own things that go up and down. Most people believe they're investing when they're actually gambling. They think they're building wealth when they're just riding waves, and when the wave crashes, and it always does, they lose everything. Today we're going to explore the difference between speculation and wealth, not to tell you what to buy, not to give investment advice, but to show you a completely different way of thinking about money, risk, and time. If you're ready to understand why most people fail at building wealth even when they own appreciating assets, hit subscribe because this might challenge everything you believe about getting rich. Let's begin. Let me start by defining two terms that most people use interchangeably but shouldn't: speculation and wealth building. These are not the same thing, not even close. Speculation is buying something hoping the price goes up so you can sell it to someone else at a profit. The value comes from price movement, nothing else. You're not creating anything. You're not building anything. You're betting on human psychology and market timing. You win if you sell before it crashes. You lose if you hold too long. Wealth building is acquiring assets that generate value regardless of price, cash flow, dividends, rent, business profits. The asset produces something independent of what someone else will pay for it tomorrow. You win over time through ownership and production, not through perfect timing. Here's the test. If the market closed for 10 years and you couldn't sell, would you still want to own it? If the answer is no, you're speculating. If the answer is yes because it pays you or produces value, you're building wealth. Most people buying XRP, Bitcoin, stocks, or real estate are speculating even though they call it investing. They're betting on price appreciation. They're watching charts. They're hoping someone pays more tomorrow than they paid today. That's speculation. It's not evil, it's not wrong, but it's not wealth building. And confusing the two is how people with impressive portfolios still end up broke. Now let me explain the psychological difference because this is where everything breaks. Speculators are emotionally tied to price. Their self-worth fluctuates with the market. Green day equals good day. Red day equals bad day. They check prices constantly. They read every headline. They join communities where everyone reinforces their beliefs. They need validation from others who also hold the asset. When price goes up, they feel smart. When price goes down, they feel stupid. Their entire emotional state is hostage to something they can't control, what someone else will pay tomorrow. Wealth builders are emotionally detached from price. They care about the underlying fundamentals. Is the business growing? Is the rental property generating cash flow? Is the dividend increasing? Price is interesting, but not important. They might check it once a quarter or once a year. They don't care what others think. They don't need validation. They measure success by value created, not price achieved. Here's a real example. Two people buy a rental property for $300,000. Speculator A obsesses over the property's market value, checks Zillow constantly, stresses when home prices dip, celebrates when values rise, never refinances, never improves the property, just waits for appreciation so they can sell at a profit. Meanwhile, the property barely breaks even on rent because they overpaid. Wealth builder B doesn't care what Zillow says, focuses on cash flow, makes sure rent covers all expenses plus profit, reinvests cash flow into improvements that increase rent, refinances when rates drop to pull out equity, uses that equity to buy another property. 10 years later, speculator A has a property worth $400,000 on paper, but still only one property generating minimal cash flow. Wealth builder B has 5 properties generating significant monthly income. The properties might be worth the same or less than A's single property, but B has income, B has options, B has wealth, same starting point, different psychology, completely different outcomes. Let me take you into the world of crypto to illustrate how speculation masquerades as investing. XRP has $1.25 billion in ETF assets, regulatory clarity from the 2025 SEC settlement, over 300 financial institutions using RippleNet, and $15 billion processed through on-demand liquidity in 2024. Every piece of fundamental news sounds incredible, and yet, XRP fell 13% in 2025, despite all these developments. How is that possible? Because fundamentals don't drive speculation. Psychology does. Early investors saw the ETF news and institutional adoption as their exit opportunity. They sold $721 million worth of positions into the liquidity spike. Meanwhile, retail investors bought the hype thinking headlines equal profits. They're not building wealth. They're speculating on whether someone else will pay more tomorrow. Here's the test. Does XRP pay you to hold it? Does it generate cash flow? Does it produce anything while you own it? Or does your entire return depend on price appreciation and selling to someone else? That's pure speculation. Now compare that to someone who buys dividend-paying stocks. The company pays them quarterly, regardless of price. If the market closes for 10 years, they still collect dividends. That's wealth building. The speculator needs the market to go up. The wealth builder doesn't care. And this applies to everything. Bitcoin, stocks without dividends, gold, real estate bought purely for appreciation, even art. If your entire return depends on price going up, you're speculating. You might make money. You might lose money, but you're not building wealth. You're gambling on human behavior. Now let me show you what happens when economic cycles turn, because this is where speculation gets destroyed and wealth building survives. The yield curve inverted in October 2022 and remained inverted until December 2024, the longest inversion in modern history. Since 1960, the spread between the 3-month and 10-year Treasury yield has inverted before every U.S. recession, making it one of the most reliable economic indicators. The curve uninverted around April 2025, and historically, there tends to be a months-long delay until a recession formally starts, with models rating a very high likelihood of recession for the 0 to 6 months following normalization. What does this mean for speculators versus wealth builders? When recession hits, speculators panic. They bought assets expecting prices to keep rising. When prices fall, they have no income to sustain them, no cash flow, no dividends, just falling numbers on a screen. They're forced to sell at losses because they need liquidity. They never built wealth. They just rode a wave up and got caught when it crashed. Wealth builders barely notice. Their rental properties still generate rent. Their dividend stocks still pay quarterly. Their businesses still produce revenue. Price drops don't matter because they're not selling. They're collecting income. In fact, falling prices are opportunities to buy more income-generating assets at discounts. Yield curve inversions have preceded each of the last 8 recessions, with the rule of thumb that an inverted curve indicates a recession in about a year. But here's the part speculators miss. The yield curve typically inverts between 6 months and 2 years before a recession begins, giving wealth builders time to prepare while speculators keep gambling. This is why speculation feels good until it doesn't, and wealth building feels boring until you realize you're financially free while everyone else is panicking. Let me tell you about the greatest speculators in history and what happened to them, because this pattern repeats in every bubble. 1920s stock market. People mortgaged homes to buy stocks on margin. Prices went vertical. Everyone felt rich. Then 1929 hit. Stocks crashed 89%. Millionaires became homeless. Why? They weren't building wealth. They were speculating on price. When price collapsed, they had nothing. No income, no cash flow, just worthless paper. 1990s dot-com bubble. Tech stocks multiplied 10x, 50x, 100x. People quit jobs to day trade. Everyone had a portfolio worth millions on paper. Then 2000 hit. NASDAQ dropped 78%. Trillions vanished. Why? These weren't businesses generating profits. They were speculative bets on future earnings that never materialized. When reality hit, fortunes evaporated overnight. 2008 housing crisis. Real estate only goes up, they said. People bought investment properties with zero down, negative cash flow, betting on appreciation. Then prices fell. Suddenly, they owned properties worth less than the mortgage with negative cash flow draining them monthly. Millions lost everything. Why? They were speculating on price appreciation, not building wealth through cash flow. Same pattern, different asset, identical outcome. Now look at 2025. The yield curve steepened around April 2025 after the longest inversion on record, with the spread between 30-year and 2-year yields widening to 122 basis points. The signal is clear. Yet millions are speculating on crypto, meme stocks, and overpriced real estate betting prices will keep rising. They're calling it investing. It's speculation. And when the cycle turns, the same story will repeat. So what does real wealth building actually look like? Let me paint the picture because it's boring, unsexy, and it works every single time. Wealth Builder starts with emergency fund, 6 months expenses in cash, not invested, just sitting there providing security and optionality. They automate 15% of every paycheck into index funds that pay dividends, not exciting stocks, not crypto, boring funds that own everything and pay quarterly. They buy a modest house well below what they can afford, not to impress anyone, just for shelter and stability. They keep the mortgage payment at 25% of income maximum. They drive a paid-off car, not new, not fancy, just reliable. They invest in skills that increase their income, courses, certifications, side businesses. They focus on earning more, not just saving more. They build systems that remove emotion from decisions, automatic transfers, automatic investments, rules they follow regardless of feelings. 10 years pass. Their investment accounts have grown steadily through dividends and compound growth. They've been promoted 3 times because they invested in skills. Their income doubled. Their house is almost paid off. They bought a rental property that generates cash flow. They have options, security, freedom. They don't look rich. They don't drive luxury cars. They don't post about investments on social media, but they're wealthy. Meanwhile, the speculator spent 10 years chasing XRP, then Bitcoin, then Tesla, then real estate, then meme stocks. They made money sometimes, lost money other times, felt smart, felt stupid, experienced extreme highs and lows, and after 10 years, they have a scattered portfolio of speculative assets that fluctuate wildly and generate zero income. They still stress about money. They still feel one bad market away from disaster because they never built wealth. They just speculated. Here's what nobody tells you about speculation versus wealth. Speculation requires perfect timing. You need to buy low and sell high. Miss the timing and you lose everything. It's exhausting, stressful, and statistically, most people fail. Wealth building requires no timing. You buy quality assets that generate value. You hold them for decades. You collect the income. Time is your friend, not your enemy. The difference is freedom. Speculators are prisoners to the market. They need things to go up. They need liquidity. They need someone else to validate their bet by paying more. Wealth builders are free. They don't need the market to do anything. They're collecting income regardless of price. They can wait forever if needed because the assets are working for them. Let me give you one final comparison that summarizes everything. Speculator buys $100,000 of assets hoping they appreciate to $200,000 so they can sell and make a profit. If price doesn't cooperate, they're stuck. They made zero. They're stressed. They're watching charts. Wealth Builder buys $100,000 of assets that generate $8,000 per year in cash flow. In 1 year, they made $8,000 regardless of price. In 10 years, they made $80,000 in income, plus whatever appreciation happened. In 20 years, they made $160,000 in income plus appreciation. But here's the key. They don't care about appreciation. The income is the wealth. The price is just a number. This is the difference between owning things and building wealth, between betting on tomorrow and getting paid today, between speculation and freedom. Let me address the question everyone asks. But what about the people who got rich speculating? They exist. And here's what every single one has in common that nobody talks about. They either got extraordinarily lucky with timing, which is survivorship bias. For every person who got rich speculating on Bitcoin in 2013, 10,000 people lost money buying at tops and selling at bottoms. You only hear about the winners. Or they already had wealth from traditional means and used a small portion to speculate. The speculation wasn't how they built wealth. It was how they gambled with wealth they already had. Or they're lying. Social media is filled with people faking success to sell courses, pump assets they hold, or feed their ego. Most people claiming they got rich from speculation are broke in reality. The uncomfortable truth is this: speculation might make you money. Might. With luck and timing. But it will never give you financial peace. Because even if you win, you're terrified of losing it. You're still watching charts, still stressed, still one bad trade from disaster. Wealth building gives you peace. Because your wealth isn't dependent on price, it's dependent on systems that produce value regardless of what markets do. You sleep well, you have options, you have time. That's the real prize, not numbers on a screen, but freedom from the screen entirely. So here's what you do if you want to stop speculating and start building wealth. First, be honest about what you own. Is it generating cash flow or are you betting on price? If it's pure speculation, acknowledge it. Don't lie to yourself. Second, decide your allocation. Maybe you keep 5 to 10% in speculation for excitement. Fine, but put 90% in wealth-building assets, dividend stocks, real estate with cash flow, businesses, index funds, things that pay you. Third, stop checking prices. If an asset doesn't pay you monthly or quarterly, you don't need to check it daily. Fourth, build systems that automate wealth, automatic savings, automatic investments, automatic income. Remove emotions from decisions. Fifth, focus on increasing income, not just assets, skills, career moves, side businesses. Wealth comes from earning power, not just investment returns. Sixth, measure success by cash flow, not net worth. Net worth fluctuates with markets. Cash flow is real money you can spend. Seventh, give yourself a long time horizon. Wealth building takes decades. Speculation wants results tomorrow. And finally, understand that boring wins. The most boring strategies, executed consistently over long periods, create real wealth. The exciting strategies create stories, sometimes good stories, often painful ones, but rarely wealth. Here's the final truth about speculation versus wealth. Speculation is entertainment disguised as investing. It's gambling with a financial vocabulary. It feels productive, it feels smart, but it's not building anything real. Wealth building is boring work that compounds over time into freedom. No excitement, no drama, just steady progress toward a life where money doesn't control you. The yield curve inverted for over 2 years. It uninverted in 2025. Since 1960, every recession has been preceded by a yield curve inversion, and models rate a very high likelihood of recession within 6 months after normalization. The economic cycle is turning. When recession hits, speculators will panic, assets will crash, portfolios will vanish, and people will wonder what happened. Wealth builders will barely notice. They'll keep collecting rent, keep receiving dividends, keep earning income, and when assets crash, they'll buy more at discounts. This is the power of knowing the difference, not between assets, between strategies, between betting on tomorrow and getting paid today, between speculation and wealth. Most people never learn this. They spend their entire lives chasing, hoping, timing, stressing, and they retire with nothing but stories about the one that got away. The few who understand build quietly, live modestly, invest consistently, and retire free, not because they picked the right asset, but because they understood what wealth actually means. And it's not a number on a screen. It's the freedom to live life on your terms regardless of what markets do. That's wealth. Everything else is just speculation. If this changed how you think about money and freedom, hit subscribe right now because we're building a community of people who choose wealth over entertainment. Drop a comment and tell me honestly, are you speculating or building wealth? And if you found this valuable, share it with someone who needs to stop checking prices and start building systems. Because the difference between being rich and being free isn't complicated. It's just knowing whether you're betting on tomorrow or getting paid today. See you in the next one.